The U.S. stock market has entered a clear and undeniable state of panic. Just days ago, there was a growing sentiment among some investors that a short-term bounce might take place. That bounce never materialized. What this demonstrates is that trading based on instinct or emotion is not only unreliable, but dangerous. Even seasoned professionals with decades of market exposure can be tempted by gut feelings. But in environments like this, discipline and risk management are what separates surviving traders from losing ones. Despite any temporary optimism, short-term downside risk was still dominant. Many participants who failed to acknowledge that are now finding themselves forced out of positions. Welcome to Crown Trading, where we specialize in teaching investors how to trade momentum and growth stocks. I've been a trader for over 10 years and have traded countless strategies until I found one that made the most sense to me. Momentum trading. What we're seeing unfold is not just another routine pullback. It's accompanied by textbook signs of market stress, increased volatility, and a breakdown in risk appetite. Although the level of fear we're witnessing often coincides with attractive long-term buying opportunities, we're not convinced that this correction has bottomed out yet. One major red flag is the recent triggering of a rare but historically significant risk signal. This signal has only occurred a handful of times in the last 2 decades, each time preceding major equity market drawdowns. The most notable examples include the 27% drop in 2022, the 33.9% COVID crash in 2020, and the 57% collapse during the 2008 financial crisis. Every instance involved a sudden shift in global risk appetite, followed by accelerated downside momentum in equity markets. Digging deeper into current conditions, it becomes clear that bond markets are sounding the alarm as well. The 10-year U.S. Treasury yield has slid from a recent high of 4.34%. This kind of drop in yields suggests that investors are fleeing risk assets and piling into government bonds, not because they expect inflation to fall, but because they fear a slowdown in economic activity. This behavior contrasts sharply with what we saw in 2022, when the market sell-off was driven by surging yields amid inflation fears and aggressive Federal Reserve tightening. Today, bond investors seem more concerned about deteriorating growth conditions. There have been at least 6 major market corrections of 10% or more since 2008 that were primarily linked to growth scares rather than policy tightening. In those cases, the average decline was 17%, with the 2011 and 2018 events narrowly avoiding official bear market status. Additionally, those corrections were often accompanied by credit market stress, deteriorating consumer confidence, and increased layoffs, signs that typically follow in the next stage of economic deceleration. While those elements aren't in full swing yet, initial jobless claims have recently ticked up, and small business optimism, measured by the NFIB index, has dropped to levels not seen since 2012. Adding to this wave of caution is the dramatic spike in the CBOE volatility index, which climbed above 36, a psychological threshold that has historically signaled fear-driven selling. During the COVID crash, the VIX spiked to 85, and in October 2008, it surged to 89. While today's reading is far from those extremes, a move above 35 has, in most cases, coincided with or preceded capitulation events. Even during smaller pullbacks like the February 2018 volatility spike, the VYX breached 35 before markets stabilized. In essence, a spike of this nature is often the signal that investors are no longer adjusting portfolios. They're selling in a panic. If you've enjoyed this video so far, hit the thumbs up button down below. That way you can help spread our content to as many people as possible. Also, if you are interested in getting our top stock picks that work in any market environment emailed to you every week, hit the link below in the description to get our next picks now. One of the most overlooked but powerful indicators that has resurfaced is the gold to silver ratio. This ratio is used by traders and macro analysts to assess risk sentiment in commodities and the broader financial system. Silver tends to outperform gold during periods of confidence and risk-taking. Gold, on the other hand, dominates during times of stress. Currently, the ratio has surged to above 90-1, breaching a consolidation range that had held since 2022. Historically, a breakout in this ratio has preceded sharp equity declines. In April 2022, the ratio began rising rapidly, and the S&P 500 lost 20% in the following 3 months. In February 2020, the ratio exploded to over 120, marking the onset of the COVID crash. In 2008, it rose steeply just ahead of the financial crisis meltdown. This recent breakout is signaling, loud and clear, that the market is abandoning risk and running to safety. So, does this mean the US is headed into a recession? Not necessarily, but the odds are rising. The current economic data presents a mixed bag. On one hand, the labor market remains resilient, with unemployment still below 4%, and GDP growth in Q4 2024 was revised upward to 3.1%. However, forward-looking indicators are flashing yellow. The ISM Manufacturing Index has now been in contraction territory for 15 consecutive months, and consumer credit growth is slowing sharply, combined with potential external shocks, like the proposed Trump-era tariffs on imports, which could act as a tax on consumers and strain corporate margins. The risk of an economic slowdown deepening into a formal recession cannot be dismissed. Still, even in bear markets and recessions, markets do not decline in straight lines. There are always counter-trend rallies, sometimes sharp ones, that offer strategic entry points or opportunities to de-risk. It's during these phases that preparation matters most. This is not a time for overconfidence or reactionary trading. It's a time to manage exposure wisely, remain alert to structural shifts, and focus on capital preservation over aggressive accumulation. The current market landscape demands a clear-eyed approach, one built on data, history, and strategic thinking. Those who can do that will not only weather the storm, they'll be positioned to capitalize when conditions eventually turn. Watch the next video on the screen to learn more about the momentum strategies we are using in the stock market.